A mega media deal, a cryptocurrency crash, and adjusting to a world without COVID restrictions, leaving investors to sort out the signal from the noise. This is Bloomberg Wall Street Week. I'm David Westin. This week, Dr. Anthony Fauci and IMF head Kristalina Georgieva on the risks we face if we don't vaccinate everyone, and I mean everyone.
We have taken a leadership role globally with other diseases, and I believe we can do that with COVID-19.
We are not going to see full economic recovery until we are out of the health crisis.
CEOs David Zaslav of Discovery and John Stankey of AT&T on the huge shift in the media business that made them both turn their companies around together.
I think with these assets together, we're going to have a hell of a run.
I can't in good conscience not allow these assets to develop to their full potential.
And Larry Summers on the crypto craze and his inflation watch. It was a week full of adventure. Discovery and AT&T announced the biggest media deal since AT&T bought the Warner Media assets it's now getting rid of.
In 2016, I don't think we had a clear picture of what the global opportunity was going to be in direct-to-consumer.
President Biden traveled to Dearborn, Michigan to help Ford launch its new all-electric F-150 pickup as part of the drive to make the United States trade in its internal combustion engines for electric motors.
We're going to go in the battery production business. Something we used to buy off the shelf, we're now vertically integrating these batteries.
And cryptocurrencies fell off a cliff, only to crawl back again, at least when it comes to Bitcoin.
They're all suggesting that we are in the capitulation phase, which is a really great time to buy.
But for all the drama, it really came down to two fundamentals driving the economy. The reemergence of the U.S. economy from the dark cave of COVID, even as concerns remain about the unvaccinated.
Unvaccinated people should continue to wear a mask and social distance.
And the incredible liquidity injected into markets by monetary and fiscal policy, with questions about how long that can last.
When policy is effective, it creates a soft landing that you don't notice. The fact that policy is moving from emergency to easy to more normalized conditions.
There was some true drama this week and more than a little bit of excitement as well. But in the end, the markets came out of the week not all that much different from where they started, with the S&P 500 down just a tad and the NASDAQ up just a tad, while the 10-year yield lost less than a basis point. But what was not calm this week was Bitcoin. It plunged from a high of $44,000 at the beginning of the week down to $35,000 on Friday. But in between, it went all the way down to $30,000, all the way up to $42,000. And as I say, it ended up at $35,000 at the end of the week. It was all exciting to watch, but did it signify much beyond the four corners of crypto land? For that, we turn to our regular contributor, Jillian Tett of the Financial Times, where she is chair of the editorial board and editor-at-large U.S. Jillian, great to have you, particularly because you've really studied crypto so carefully. Does it have any significance beyond the four corners of crypto land?
Well, here's the good news. It doesn't have that much significance because at the end of the day, it still is only a $2 trillion market, and that is not enough to make it truly systemic. And we have seen dramatic swings in cryptocurrencies before. It's worth remembering that you don't have market makers in this sector. So, of course, that tends to make it a lot more volatile than most of the other types of assets like equities that investors may be looking at. But the bad news is that this does show that the foundations of cryptocurrency are a lot shakier than many of the enthusiasts have actually factored in before. There's a lot of opacity. There's a lot of dependency on what stance the regulators are going to take, and we still don't really know what stance that's going to be. And the other point to make, which is really important, is that all of this is coming as not only Wall Street banks, but big asset managers like Fidelity start to move into this land. And of course, this week, the other bit of really big news was that the Federal Reserve, along with other central banks, is looking at whether it could create a digital currency of its own.
So let's talk about that. Are the regulators more or less declaring a form of war on cryptocurrency? I mean, because you had, as you said, the Jay Powell, the chairman of the Fed, coming out saying, we're going to spend the summer studying this. We're going to come up with a report exactly what we want to do on digital currency. And then you had both the PBOC saying, don't you dare trade in this stuff, buy stuff with it in China. And you also had the state council saying, don't even mine it over here. It sounds like the regulators are starting to get their dander up.
Well, there's two or three things going on here. On the one hand, there's a regulator saying, actually, the underlying technology of what's going on here, the blockchain, is actually potentially very useful. But if that is going to be useful, we actually want to try and control it some way and ensure that money is still tethered to a central bank. And one of the biggest risks to Bitcoin and other types of tokens going forward is that if the central banks ever get serious about creating their own digital currency, they could essentially squeeze out a lot of these bottom-up innovations. At the same time, you're seeing regulators saying, well, we're getting concerned about the tax implications of all this. And the IRS indicated that it's going to start treating Bitcoin like any other asset and demanding a lot more disclosure, reporting, and of course, payment of taxes. And again, it's unclear whether people have factored that in or not. And then last but not least, you have the regulators who are trying to work out how they're going to control, shape, monitor, define this. China said they're going to stop their banks essentially dealing with this, but and other jurisdictions will be doing the same. Turkey came in with very strong rules quite recently too. But at the heart of the regulatory dilemma is a debate going on amongst regulators about, is this a currency, in which case someone like the Fed should be involved? Is it a security, in which case someone like the SEC should be involved? Or is it actually a commodity, a store of value, more like gold, in which case maybe the CFTC should be involved? And right now the answer is not clear, so there's a lot of uncertainty swirling around the whole crypto space.
And maybe, Gillian, that's another way of asking the question that I have, which is, what role, if any, does this play in the larger financial system? I mean, right now, given the volatility, you can't really buy things. You can't denominate prices in this, as Elon Musk apparently has concluded with Tesla. It's not really investable given the volatility. So what role, if there is a role in the larger financial plan, does it serve?
Well, if there were any CFOs who were thinking of following Tesla and making it part of their portfolio strategy, right now they certainly are not going to do that given how volatile it is. So we know it's not a stable short-term store of value. We know it's not a very good payment system at all, because if it's going up and down in price, why would you use it to pay for anything? So it's probably best considered more like a speculative type of security right now, which, you know, is not the end of the world. But that's certainly the way that probably investors should be seeing it if they are looking at it at the moment. But there's one other very important thing to point out as well, which is that when Elon Musk came out and expressed reservations about Bitcoin recently, he did so for environmental reasons. That shouldn't be a surprise to anyone who's been in this space. We at the Financial Times have written a lot about this. And in fact, one of our top performing stories this week was a deep dive into the environmental implications of Bitcoin. There's a lot of activity right now in the fintech world and in environmental groups trying to see if they can find a green Bitcoin, which doesn't consume quite so much energy, or rather a green cryptocurrency that isn't Bitcoin, because probably the answer is going to lie in something other than Bitcoin. But again, as people are saying, well, I can see down the tracks, there could be an investor revolt against dirty Bitcoin and people flooding to other newer currencies, which are less environmentally damaging. That's creating volatility too.
Yeah, it leaves us to wonder why Elon Musk, who's clearly very bright, didn't read the notes about the green issue, because as you say,
he should
it's
have
been
read
around for a while.
He could have seen the FT, so we've written about it so many times, you know. But
Exactly, exactly. Thank you so much to Jillian Tett of the Financial Times for joining us here on Wall Street Week. Coming up, pre-pandemic life is within reach for vaccinated Americans, but Dr. Anthony Fauci says that a sustained sense of normalcy will depend on a global effort.
The easiest way to do that is to get as many people throughout the world vaccinated as quickly as you possibly can.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Over the last 15 months, the biggest fundamental of all is the path of the coronavirus and what it means for the economy. Through it all, Dr. Anthony Fauci has been our guide. And so we asked President Biden's chief medical advisor where we are and whether it's safe to open up our economy fully before everyone is vaccinated.
The CDC came out with guidance a few days ago last week and said if you are fully vaccinated, you should feel safe that you can go without a mask, not only outdoors, but also indoors. That was directed specifically at people who were fully vaccinated. The problem is, David, that what happened is that people interpreted that was a signal to say that you don't need masks anymore, which absolutely is not the case, because for people who are not vaccinated and still vulnerable and susceptible to infection, that you still have to follow the CDC guidelines that have not at all changed for that group. And that's where the confusion is. It applies only to people who are fully vaccinated.
So, Doctor, clearly it applies only to those fully vaccinated, and those of us who are fully vaccinated feel privileged to have that. But we don't know who's fully vaccinated. So if I'm running a business, whether it's a small retail store or it's a huge company, I don't necessarily know who's vaccinated and who's not. How do I figure out which is which?
Well, David, you just hit the nail right on the head of what the issue is. Since we are not centrally requiring proof of vaccinations, namely from the federal government on down, you gave an example which is a perfect example of what we're facing. So let's say I'm an owner of an establishment, whatever that establishment is, and I am aware of the CDC guidelines saying that if people who are vaccinated can feel safe outdoors and indoors without a mask, what I don't know is coming into my establishment who's vaccinated and who's not, which means you don't know who's infected and who's not, and what the risk of transmitting an infection within my establishment. And it's for that reason why there are some establishment owners and people responsible for the establishment who are saying, full understanding the CDC guidelines, if you want to come into my establishment, you have to wear a mask. And that's where some of the confusion is, David, because you're saying, wait a minute, the CDC is saying that if you're vaccinated, you don't have to wear a mask. And now you're telling me I have to wear a mask if I come into your... That's something that needs to be cleared up for sure. But what we are going to see, and we're seeing it already, is that there are organizations, particularly universities and colleges, who are saying, notwithstanding what the federal government is requiring, if you want to come into campus and be in-person learning, you're going to have to show proof of vaccination. Cruise ships will likely be doing that. Airlines will likely be doing that. So you're going to have at the local independent level things that the federal government is not going to be mandating.
Dr. Fauci, there's also a lot of report about so-called variants that tend to get named after the country where they're first discovered. And right now, of course, we have India, which may be the most frightening variant of all. Given the fact that this virus continues around the world, we are not stamping it out, is it just a matter of time before there is a variant that, in fact, is resistant to the vaccines that we have?
You know, not necessarily at all, David. And one of the ways that you can prevent that from happening is treating this as a global pandemic and trying to get the entire world vaccinated. There's a very important tenet in virology, is that viruses don't mutate if they don't replicate. So if you prevent it from spreading from person to person and replicating, it's not going to mutate. So the easiest way to prevent the emergence of a problematic mutant, which would lead to a variant, the easiest way to do that is to get as many people throughout the world vaccinated as quickly as you possibly can. Because if you have a country like the United States, which sometime, let's say in the summer, we're really in good shape, we got a lot of people vaccinated, the level of infection has gone way, way down, and yet you have other regions of the world where there's a very robust viral dynamic and people are getting infected, the chances of there being the emergence of a variant there are strong, and that variant might come here. That's the reason why we've got to treat it as a global pandemic, not of an epidemic just in our own country.
That was President Biden's chief medical advisor, Dr. Anthony Fauci. The nature of a pandemic is that it knows no boundaries. And on Friday, the IMF announced a new program to get not just the United States, but the rest of the world vaccinated, or at least 60% of it by early next year. IMF Managing Director Kristalina Georgieva took us through the program, what it will cost, and the economic benefits we can all realize.
What we recognize is that we are not going to see full economic recovery until we are out of the health crisis. And we asked the question, what would it take to vaccinate the world population by the end of this year at the level of 40%, and by mid next year at the level of 60%, that would bring that acceleration of recovery everywhere. And the answer is, one, we need to inject upfront financing in COVAX. This is the facility that helps developing countries to bring vaccines to their people. We have to fund it now, not make commitments for some future. We have to get countries with access vaccines to make now a commitment to release what they don't need for their own people, so it can be integrated in vaccinations plans in the developing world.
But Madam Georgieva, several times in that answer you said now, and goodness knows as we watch what's happening in India, watch what's happening in Brazil, it has to be now. We don't have any time to wait. Can you get the $50 billion now? How long will it take to come up with that kind of money?
I got quite encouraged by the discussion at the Global Health Summit today, because we heard from many countries step-up commitments in financial terms and also in reallocating excess vaccines. And I can tell you we will continue to press through the meetings that are forthcoming, G7, G20 meetings, to make sure that it is happening now. We have been fortunate as a world in two ways. One, our scientists came up with vaccines in a record short time. Two, our central bankers and our finance authorities have provided incredibly strong fiscal and monetary support so we can go through this pandemic. What is left is this: vaccinate everybody everywhere as fast as we can. And I am optimistic that we all would see it in our own interest and that we will step up. We at the fund have been on the front line. We have provided financial lifelines to 82 countries in record short time. We will continue to do our part, but we want to see also more grant contributions, especially for the poorest countries, to come now.
That was IMF Managing Director Kristalina Georgieva. Coming up, a world awash with cash. That's what BlackRock's Rieder sees. And inflation is the risk, particularly when it comes to housing.
If you said to me, what's going to be durable in terms of inflation, it will be shelter.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. One of the things roiling markets this week was the specter of inflation, with the debate continuing to rage about whether it poses a real danger or not. Rick Rieder is BlackRock Chief Investment Officer for Fixed Income and Head of Asset Allocation, and he says there's just too much liquidity in the market, and we're seeing it particularly in things like housing. But that does not necessarily mean we'll have runaway inflation.
If you said to me, what's going to be durable in terms of inflation, it will be shelter. It will be the fact that we don't have enough homes. And what's happening is home builders are trying, and they're building, and they're pumping out product as quickly as possible. You're going to get to the labor shortage dynamic. The hard thing for home builders is to get enough people to try and create enough homes. But let me give you some crazy stat relative to this. Lumber prices. If you take the average price of a home, which is a little over $300,000, lumber prices alone have grown about $36,000 on an average home. So think about what that is on an just over $300,000 home. Lumber, that's not copper, that's not everything else. Meaning you're getting this drawdown of inventory and some pretty accelerated pricing. And again, I would argue the Fed doesn't need to buy agency mortgages anymore. And by the way, the mortgage rates won't move up that much because there's so much natural demand in the system for real estate financing and for mortgage product. But to let them normalize a little bit, actually, I think will actually create a better environment for investing in mortgages.
So what should the Fed do at this point if they start adjusting their policy? And I know you're particularly concerned about the short end of the curve versus the long end of the curve, because the long end of the curve is where corporations get financed themselves and also, frankly, people buy mortgages.
Exactly right. I mean, So I think, the front end of the yield curve, there's plenty of buyers of Treasury bills. There's plenty of buyers of 2-year notes. The explosion of money into money market funds, into bank deposits. The front end will live perfectly fine without backing up of any significance or having any pressure without the Fed continuing to be involved there. But I think where the Fed needs to be over certainly the next 6 months, the next year, the next 2 years, is think about longer end interest rates. And that's longer than 5 years interest rates, because the Treasury is going to issue because of the fiscal programs, is going to issue an awful lot of debt. So if I were the Fed, I would taper down the amount of buying they're doing in the front end, save some powder for continuing to be a buyer in the longer end of the yield curve. And, in case people get too worried about inflation, in case people get too worried and real rates back up. But I would start to move your taper. I would start to taper sooner rather than later. But, we have to watch, how they're going to think through that. But I would start to taper it, and I would leave the front end. I would do much less buying in the front end of the yield curve and liquidity in the front end, but focus more on the longer end and do that, quite frankly, over the next couple of years. But by doing that, you can reduce the amount of size that you're doing, the amount of liquidity you're putting in a very significant way.
It certainly appears that the Fed is very concerned about moving too soon. What are the consequences of moving too late? What if they do, in fact, move too late? How could that hurt us?
Yeah, David, that's a great question, and I think people underestimate that. Listen, the discussion every meeting I have is all about overheating. The first, second, and third questions are overheating, inflation, what's the risk? And so, that starts to work its way into the psychology of not just investors, but also in terms of corporates, et cetera. So anyway, that's a big deal. Distortion of financial assets. We've seen this play out over time. You now have an economy that is not a traditional manufacturing economy. The financial system is much more intertwined with the real economy that's ever been before. If continuing to inflate asset prices, particularly in some of these safe or high quality assets, forces people to take more risk to hit their return objectives, or take more risk to hit their liability objectives. And that becomes a really risky paradigm the longer that goes on. So it's the overheating, it's the inflation of asset prices, and so creating more of a soft landing that makes, you've seen that over time. When policy is effective, it creates a soft landing that you don't notice the fact that policy is moving from emergency to easy to more normalized conditions.
So, Rick, finally, give us some investment advice here. You're responsible for placing an awful lot of money, debt and equity, for BlackRock. What is the sensible investment strategy given all that we've just talked about?
Listen, I think for the time being, like I said, I think the markets have become a little jittery. They're a little concerned about some of these concepts we talked about. So I think keeping some powder dry, we're holding higher levels of cash than we've had historically. But I also think equities are going higher. When you look at, I think you're going to see this tremendous growth. It leads to corporate revenue growth, earnings growth, cash flow growth. So I still like equities. I like owning a lot of yielding assets, securitized assets, things like we talk about in the residential real estate, even the commercial real estate area, I think makes a lot of sense. And some of the credit markets, get some yield in a portfolio, take some equity in the portfolio, some of the alternatives make sense. But I'd hold more powder, because I think we're going to see the second half of the year, I think you're going to see some real volatility. And I think, making sure you've built some convexity into your portfolio. We use a lot of options to make sure we've got some convexity in the portfolio, more cash, run a bit more conservative than you would have 3 to 6 months ago, because we're in a bit of a transitional period here.
That was BlackRock's Rick Rieder. Coming up, remaking the media world again, this time for streaming. We talk with Discovery President David Zaslav about why he thinks this will give him the winning hand.
When we come together, we think it makes us a real formidable global IP business.
This is Wall Street Week on Bloomberg. Game of Thrones and 90 Day Fiancé are joining a new blended family. For years, Wall Street has called on AT&T to give up on its media dreams and get more focused on 5G. This week, it succumbed, announcing that CNN and HBO and its Warner Media division will leave the telecommunications giant and join forces with Discovery, home of the Food Network and TLC.
That's really the lesson of AT&T, having bought without really understanding it. DirecTV at exactly the wrong time, and Time Warner at equally a wrong time.
The deal reverses the one in which AT&T paid $81 billion to buy Time Warner, one in which it had to fight off a challenge from the Justice Department, and it comes after AT&T already beat a retreat from its DirecTV business, selling 30% to TPG. In contrast, David Zaslav has been steadily accumulating media heft, including with Discovery's 2018 purchase of Scripps Networks.
It is a clear concession of defeat for AT&T. It just didn't work. They paid too much.
The big question is what this will mean for the new media behemoth as it competes for streaming business against the likes of Disney and Netflix. Both Discovery and AT&T have their own streaming platforms, but didn't say whether HBO Max and the newly launched Discovery Plus would be folded together.
I think HBO Max has potential to create more value, but AT&T couldn't wait. So I think this is a really good outcome for Discovery.
And the media dance is not over yet. Amazon is looking to buy MGM, whose library includes the Rocky and the James Bond franchises. The reported acquisition talks signal Amazon's focus on entertainment. And analysts speculate whether others like Comcast and Viacom can be far behind.
The M&A market has never been more active than it is right now. Just talk to anyone in the space.
We talked with the two men who started it all this week. Discovery CEO David Zaslav and AT&T CEO John Stankey. And for both of them, it is setting off on a very new course, quite different from the one they've been on. For David Zaslav, it's giving up the relatively low-cost, unscripted programming he's embraced over the years and plunging ahead into something very different. And for John Stankey, it's turning his back on an AT&T dream to move into the media world.
In many ways, we're really in the same business. We're both global IP companies. And we've been on a mission to aggregate more compelling stories and characters and IP in the U.S., which is why we did the Scripps deal with HG and Food, and why we got into business with Oprah and Chip and Jo. And so, even though our content may be less expensive, we still aggregate to about 20 to 25% of viewership, depending on any given night in the U.S. And outside the U.S., we're the leader in sports in Europe with Eurosport, and we have free-to-air channels in a number of markets where we're like NBC or CBS, as well as being in the cable nonfiction business. But John and I are really aligned in strategically trying to get to scale above the globe, to be a meaningful, scaled competitor. And in order to do that, you need great content that people love. And one of the things that we looked at, we launched Discovery Plus, very strong, great product, great reviews and app ratings. And people are using the product for 3 hours a day. But we looked at what John has, King Kong, Godzilla, the incredible brand of HBO, Sex and the City, Game of Thrones, Superman, Batman. And we started to think about it as a combustible combination.
So John, David says that you're at least in the same sort of business, even if they're different ends of the business. But you've also had something of a change of heart here. There was a major strategic decision made to really move into the media business as a telephone company. And now you're really reversing that. You're going to go back to your roots, the telephone company. Let me understand, looking back at it now, was the strategy wrong, or did something change in between? Because let's be frank, you're leaving some money on the table. There is some value being destroyed.
Well, I'd probably dispute whether or not there's value being destroyed. I'd actually say that we've managed to increase the value of the assets we bought by maybe about 30%. If you look at the cash we've taken out of the business, the assets we sold, and the effective value of this transaction, and some reasonable assumptions of once it trades as to how it's going to trade at a multiple.
John, I just want to make sure I understand that. I think you bought it at $85 billion. This is $43 billion. Are you saying you got that difference out in cash?
Well, we're getting $43 billion in cash, and we're getting 71% of the equity of the new business. So there's two parts to that. And the point of view that I think I'd have on this is the team's done a remarkable job of pivoting the asset to be effective in the direct-to-consumer world. And that's really the value that I think David and the rest of the industry see it right now. Now, what changed since we went into this was originally a point of view that this would help our connectivity business. And indeed it has. It's lowered churn. It's helped us on customer acquisition on things like selling more broadband connections. And it's raised customer satisfaction on those products. But in 2016, I don't think we had a clear picture of what the global opportunity was going to be in direct-to-consumer and whether or not that was going to be essential to playing in that space. And it's become clear that, as David just described, it's in fact going to be global. And the market opportunity for that, the value creation opportunity, is significant. It's so much more significant than the value that we get back into our connectivity business domestically in the United States to drive down churn and improve our customer acquisition, that I can't in good conscience not allow these assets to develop to their full potential and to give it the kind of exposure in the market that it needs, to get the kind of multiple on it that we just talked about that will increase value, that the share owners of AT&T at 71% will carry forward. This is the right move at this time to actually make that happen, given the changes in the environment.
So, David, the opportunity, David, really is that by putting our assets together in media, we think that we're not just better together, but that we're probably the best media company in the world. We have the most IP, we have the most in-language content, we have the greatest diversity of content, and for John, the vision here is that 2 years from now, 3 years from now, 5 years from now, we're the #1 media company in the world, and AT&T is the #1 telecom communications company in the world. And we take along 70% of our shareholders are John's shareholders, and we're creating value for them if this, if we can do everything we think we can.
So, David, I would be disappointed if you didn't have really high expectations, and I think everybody's rooting for you. At the same time, even with this really large conglomeration you're putting together here, you're still well behind Netflix and well behind Disney when it comes to subscribers in the OTT space. How are you going to make that up? And very specifically, how much you're going to have to invest in content? If you take this combined entity, will you be spending as much more or less than the two individual on content going forward?
Well, we're going to be spending a lot more than Netflix. Right now, it's between the two of us, we're spending $20 billion a year on content, and we expect to spend more than that. Together, right now, we have almost 100 million subscribers, and neither one of us have really deployed aggressively outside the U.S. And we're differentiated in a meaningful way in the U.S. now with the extraordinary IP that John and his team have built together with Discovery. It's a very differentiated and compelling offering. However we do it, whether we put it all together at one price or whether we do it as a bundle the way Disney has.
That was Discovery CEO David Zaslav and AT&T CEO John Stankey. Coming up, we take a look at the week ahead on global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It's time now for a look at what's coming up on global Wall Street in the week ahead.
David, we have 3 rate decisions in a row in the Asia Pacific, kicking off with Indonesia on Tuesday, followed by the RBNZ and BOK. All are seen standing pat. But as South Korea's export boom continues on semiconductor demand, markets are pricing for tightening in the coming year. And we have a big debut here in Hong Kong. JD Logistics, with the ticker 2618HK, is the delivery arm of China's e-commerce giant JD.com and offers investors both a value and growth play in one stop. Plus, Meituan and Pinduoduo report earnings next week. Both are in investment mode, like Alibaba and Tencent. Also on tap, Xiaomi's first set of results since it was removed from the U.S. investment ban list. Danny?
Thanks. Now, one of the big events that we'll be looking forward to in Europe next week is the EU's leader meeting. They're going to, of course, be discussing the current state with COVID and the EU, of course, now allowing travelers in who are fully vaccinated. In corporate events, we also have Deutsche Bank's AGM on Thursday.
Thanks, Danny. The CEOs of the largest U.S. banks, including J.P. Morgan and Goldman Sachs, they are set to testify before Congress for 2 straight days of hearings. The last such gathering a couple years ago saw the executives grilled for hours on topics that range from income inequality to capital rules. Outside of Washington, keep an eye on Ford, shares of the car company coming off their best week since February on greater clarity about the company's electric vehicle strategy. Executives on Wednesday are holding an investor day where we may get more details on how many EV models Ford plans to roll out. And earnings season, it's not quite over yet. Watch for reports from companies including Nordstrom, AutoZone, Toll Brothers, Best Buy, Salesforce, and the chip maker NVIDIA. David?
Thanks to Sophie, Danny, and Romaine. Coming up, we wrap up the week, as always, with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Bloomberg Wall Street Week. I'm David Westin. We're going to wrap up the week, as we always do, with our special contributor, Larry Summers of Harvard. So, Larry, I want to get to the Summers Inflation Watch we premiered last week. But before we do that, we got to talk about crypto for a moment or two, because, boy, Bitcoin took us on a wild ride this week. And let me ask the first and most basic question. Does it matter? I mean, you have said on this program you think cryptocurrency is here to stay. Why is it here to stay, and what does it do for us?
Look, does it matter to the overall economy? Does it matter to the growth of standard of livings of Americans? Is it as important an issue as it is an issue that attracts media attention? No to all of those questions. Is there a desire, and is there a long-standing human desire to hold an asset that feels separate and apart from the day-to-day workings of governments? I think the answer to that question, history shows, is yes. I think gold has been the primary asset of that kind for a long time. And I think that crypto has a chance of becoming an agreed form that people who are looking for safety hold wealth in. So my guess is that crypto is here to stay, and probably here to stay as a kind of digital gold. And if you imagine that crypto became half or even a third of the total value of the non-use value of gold, that would be a substantial appreciation from current levels. And that's why I think there's a good prospect that crypto will be part of the system for quite a while to come. But is crypto going to usher in some kind of libertarian paradise? Are most of us going to be making most of our payments using Bitcoin or some other crypto asset? I rather doubt it. Is this going to be something fundamental for commerce on the internet? It may be an important part of commerce on the internet. That's how I would think about it.
Another thing that happened this week, before we get to inflation as such, is Janet Yellen, the Treasury Secretary, went into the belly of the beast, if I could put it that way, the U.S. Chamber of Commerce, and said, you should be in favor of our plan that really has us taxing corporations more. And that's because you're actually going to make more money because of the overall investments we're making. You have a fascinating point about that, because we've also heard from President Biden, he's trying to redistribute some of the wealth. You can't have it both ways, can you?
You know, I think the most important thing to say is that the administration is in broadly the right direction on corporate taxation. Corporations can afford to pay more, and instead of having a race to the bottom globally, we should be cooperating to make sure that people can't use havens to avoid taxes. And Secretary Yellen is right in the direction of her policy. Secretary Yellen is right, and I found it a powerful speech in her emphasis on there's a lot more that government needs to do in our society, and that fundamentally we need to rebalance a bit towards public investment, and maybe even more than a bit given the magnitude of climate and health and inequality challenges. I don't, in all honesty, think that the claim that somehow an increase in corporate taxes will be good for corporate profits is a valid claim. And I was surprised and a little disappointed to see that claim made. But the argument that it was supporting is, I think, a valid and strong argument. And that's probably where the focus should be.
Let me make a broader point, or really a question for you, Larry, here. We have seen in recent years an increase in concentration in U.S. corporations, larger and larger corporations, larger and larger market shares, and yes, much, much larger profitability rates. As a matter of economics, not morality, economics, is that good or bad or neutral for the economy?
You know, David, it depends. If a company comes to have lots of market power because it gets better and better at producing and it can produce at lower and lower costs, that's good. That's what we call progress. That's what Henry Ford did with automobiles a long time ago. If a company is buying up its rivals, if a company is creating a fear that anyone who tries to innovate, they'll just get crushed, copied and crushed, that's really terrible for progress in the economy. And so I don't think you can generalize. I certainly share the view that we certainly haven't been making mistakes of too much antitrust policy in the United States over the last generation. And I think we can usefully look at stepped up antitrust policies in some cases. But I don't agree with those who seem to be suggesting, and I may be misreading some of the things that some of the people providing commentary say. If they're saying that whenever a company gets a larger market share and more profits, that's a problem that the government should go after, I think that's badly wrong. That's a situation the government should look at to see whether the competitive practices have been fair.
Larry, let's get to the summer's inflation watch, as we call it here. This is something you've been talking about right from the very beginning of President Biden's administration, a concern that we might be pumping too much money into the economy. What's happened in the last week on that front from your perspective? What are you looking at?
You know, market judgments have stayed about constant. I think if you look at the run of commentary, there's a greater awareness of it. I read the Fed as being at the fringes, at the edges of growing awareness. I don't think the Fed is projecting in a way that reflects the potential seriousness of the problem. And I think that, you know, stopping and slowing an inflationary economy's inflation is a lot like bringing a car to a stop. It's going to be much more comfortable if you start early and gently than if you wait until the last possible moment. And so I am concerned that with everything that's going on, the economy may be a bit charging towards a wall. But I would say I'm not lots more concerned or lots less concerned than I was a week ago.
And we're starting to hear from at least some of the Fed members some concern. You heard from, for example, Rob Kaplan this week saying it's time to start easing our foot off the accelerator so we don't have to jump too hard on the brake if that time comes. But one of my questions is it more than just they're sort of not paying attention, they're not acting quickly enough, or could they be contributing to the problem through expectations? By signaling so strongly they're not going to actually taper, does that potentially actually feed the beast of inflation?
Look, I think it's a broad point. You have the Fed saying that it's a whole new world and we're a whole new Fed. You have the government saying it's a whole new type of policy back to the Great Society or the New Deal. Well, if you tell people it's a new world, they're probably going to be more reluctant to form expectations based on the old world. And so I don't understand how people can argue both that expectations are fundamentally anchored and that it's a new world. And so I think a little bit more emphasis on continuity would be a good idea. I think the Fed needs to recognize that it needs to be looking forward and driving the car through the windshield rather than the side windows. Looking at the side windows might have been fine a year ago or 2 years ago when they put forward their framework. But when you've got a government that's committing itself to 15% of GDP and fiscal stimulus, when the economy has a record level of job vacancies, that's not a time when you can steer the economy through the side window.
So Larry, you've been watching the Fed so closely for so many years. Just in the final 10 or 15 seconds here, do you think they're starting to change their direction?
I hope so. I really hope so, but I'm not altogether sure.
Okay, thank you so much to our special contributor, Larry Summers of Harvard, for that review of the week. Finally, one more thought. Would you like some pepperoni and extra cheese with your Bitcoin? The friends and foes of Bitcoin had another week of slugging it out, with the friends of the currency, or whatever it is, sticking to their guns, and people like Cathie Wood of ARK predicting it will go to $500,000, even as it slid 30% in a single morning.
We go through soul-searching times like this and scrape the models, and yes, our conviction is as high.
And central bankers continuing to express their skepticism.
Our key focus is on whether and how a CBDC could improve on an already safe, effective, dynamic, and efficient U.S. domestic payment system.
But there are those who say we're missing the whole story, that it's not the crypto that matters, but the blockchain on which it's built and what that could make possible. Everything from letting people lend and borrow without the need for a pesky bank to replacing the SWIFT payment system altogether.
You have to start thinking about unbundling the sort of speculative aspect of crypto, which frankly has no value to it, and the actual value of crypto, which is a currency that settles immediately, instantaneously records a transaction.
But now there's a new entrant into the race for creative uses of crypto, the pizza franchise. The Financial Times this week tells the story of Bitcoin Pizza, a creation of Anthony Pompliano, a crypto influencer and tech investor who's decided to merge two things he loves, Bitcoin and pizza.
Everybody knows there's two things I love more than anything else in the world, Bitcoin and pizza.
The pizza is real and is sourced from your local pizzeria, with 100% of the profits going to something called the Human Rights Foundation Bitcoin Developers Fund, which, according to its website, is raising money to support open source software developers working to strengthen Bitcoin so it can be used by human rights activists all around the world. And no, I am not making this up. But there is one catch. You may be able to get your pizza. It may help fund Bitcoin developers trying to save the whole world. But the one thing you can't do is pay for that pizza using Bitcoin. No, when it comes to getting pizza, Bitcoin Pizza only takes dollars, though you can use your credit card if you want. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.